Who doesn't love a good financial crisis, right? People are freaking out about their precious money and their financial stability. Like, calm down, Karen. It's just money. But fear not, my fellow investor friends. There's always that one person who remains calm amidst all the chaos. Enter the one and only billion-dollar hedge fund manager, Ray Dalio. I mean, who else would we turn to in times of need? He's a legend, a superstar, a world-renowned investor that's been doing it since the mid-70s. He's basically a financial wizard. While everyone else is running around like chickens with their heads cut off, Dalio is chilling like a villain. He knows exactly what to do in times of crisis and prosperity. But let's be real, right now is definitely not a time of prosperity. Dalio has been warning investors since the beginning of time, since early this year, about the state of the U.S. economy and stocks. And now he's got an equally depressing outlook based on what's happened to Silicon Valley Bank's failure. Yay, more bad news. So, amidst all the noise on social media, let's take a moment to listen to the wise words of Ray Dalio. He's one of the best who's ever done it. After all, but first, who even is this guy? And why is he suddenly warning investors? It's not like he's been doing this for decades or anything. Ray Dalio, the man who went from caddying at a golf club to founding the largest hedge fund in the world, Bridgewater Associates. What a rags to riches story. Dalio didn't have a silver spoon in his mouth. His dad was a musician and his mom was a homemaker, so he had to work odd jobs as a child just to make ends meet. He got his big break when he started caddying at the Links Golf Club, where Wall Street hotshots would hang out. Soon enough, he got a job at a trading firm thanks to the Lieb family's connections. And at the ripe old age of 12, he bought $300 worth of shares for Northeast Airlines, which later tripled. Move over, Warren Buffett. Dalio continued to dabble in finance throughout high school and eventually pursued it in college, earning his degree at Long Island University. But he didn't stop there. He went on to get his MBA from Harvard Business School, because why not? After a stint at Shearson Hayden Stone, where he didn't enjoy the corporate hierarchy, Dalio founded his own firm, Bridgewater Associates. And boy, did that pay off. The firm not only weathered the storms of the 1987 stock market crash and the 2007 global market crash, but it also became the world's largest hedge fund as early as 2005. Until today, 18 years later, Bridgewater Associates holds the title for the largest hedge fund with $126 billion of assets under management. In short, Ray Dalio went from humble beginnings to making billions in the cutthroat world of finance. Maybe we should all take up caddying and see where it takes us. Dalio, one of the richest and most successful investors on Wall Street, is apparently not too thrilled with the current state of the U.S. economy. In fact, he's been sending out his prophecies of doom to all those who will listen long before the Silicon Valley Bank debacle even occurred. It's not looking bright for 2023 and 2024 thanks to a multitude of factors going against the country's economy. In a September 2022 interview with MarketWatch, Dalio stated the reasons why he believes the economy is crashing. This includes the aggressive hikes of interest rates by the Federal Reserve, the ongoing Russian-Ukrainian war, the decline of U.S. personal savings rates, the decline in both the housing and automobile industry, and the increase in credit delinquency rates, which, historically and statistically, precede a U.S. recession. This is also accompanied by the fact that the U.S. ISM Manufacturing New Orders Index dipped to a value of 42.5. The U.S. ISM Manufacturing New Orders Index is a recession predictability tool created by the Federal Reserve Bank of New York in order to anticipate a possible recession. Think of it as a recession litmus test. A value lower than 43.5 indicates a recession in the near future, and this has not failed in the past 56 years of use. In the same interview, Dalio even said, "Right now, we're very close to a 0% year. I think it's going to get worse in 2023 and 2024, which has implications for elections." If you aren't convinced by this warning, then just take a look at his actions. Last year, Bridgewater Associates pulled out more than 20% of their stakes in 6 of their top 11 holdings, which included Procter & Gamble, Johnson & Johnson, PepsiCo, Coca-Cola, Costco Wholesale, and McDonald's. The fact that the largest hedge fund in the world is pulling out is the biggest telltale sign that the market is currently shaky and not the best time to invest in. Looking under the hood of the biggest and best firms can give one more insight than listening to hours and hours of what anyone says. It just so happens that what Dalio is saying matches his actions, and that this is a sign that the market is headed for turbulent times. Maybe the first domino to fall is that of Silicon Valley Bank, which could be the precursor to the pending recession. Dalio even released an entire newsletter regarding the Silicon Valley Bank situation on LinkedIn a few days after the whole debacle occurred. In his newsletter, he said that the SVB failure was a very classic event that was bound to happen due to the short-term debt cycle. This short-term debt cycle is fueled by a self-reinforcing debt credit contraction that occurs when a domino effect contagion process continues until central banks create easy money that cancels out debt credit contraction, which then produces more new credit and debt, and the cycle continues. He also mentions how often this is the cause of any type of bubble collapse. For instance, while the 2008 Great Recession saw the housing sector collapse, it also followed the same self-reinforcing dynamic that we see with negative cash flow ventures and private equity companies not being able to handle the current interest rates. The man himself appeared on his own YouTube channel to discuss his thoughts regarding the Silicon Valley situation. In this video, Dalio briefly explained what happened with SVB and what caused it to collapse. Regarding the situation, Dalio said, "There has been a lot of creation of debt. Banks and insurance companies borrowed money at a certain rate and made investments, such as stocks and bonds, that provided lower than expected returns. Because they lost value or did not provide adequate yields relative to the cost